Good morning, good afternoon, everybody. This is Brian Nicolason, the host of the webinar today. I appreciate you taking some time to watch this. This is actually the second try. We had messed up the recording yesterday, and we only recorded a third of it. We only recorded two-thirds. We missed the first third, so I was going to have to record the first third anyway. And, with all the news and all the events going on, we just decided to re-record it. So we'll do just a second run through on this, and pretty much be the same as yesterday if you weren't able to attend. Get through here. So we're at the end of Q1 2026. We are 25% of the way through the year. Amazing. Time is flying. And another quarter of outperformance. Now, we were down 1.67% on our moderate aggressive portfolio through the end of March. The S&P 500 index that we track against, the 70/30 index, was down 3.37%. So outperformance relative, but objectively, negative performance for the quarter, following again a 20% year last year. A little bit of pullback given all the news with Iran and all that stuff. Really nothing to be too concerned about. Part of what held us up more than the overall market was our de-risking that we did in March. That was March 19th. We did that. The S&P 500 crossed its 200-day moving average, and we used that as a point to reduce equity exposure. So we sent out some webinars about that. We'll talk again about that because we made some further action on the 200-day moving average yesterday after the webinar. So another reason to just do a fresh recording. But overall, again, what we're striving to do is outperform. And in a down market, especially, is when we want to outperform. And had that S&P 500 continued its trajectory lower, we would have been protected from those losses. Okay. Again, keep tracking the Nicolason Wealth Partners all-weather portfolio, which is the individual stock portfolio we launched in 2021. Putting that up against all the nationally actively managed funds through the Schwab platform, puts us in the top 15%. So exactly where we want to be. Again, continuing to outperform, benchmarking against the best index, in my opinion, in the world, the S&P 500, U.S. domestic large cap, and to be outperforming that year over year is exactly where we want to be. And more importantly, having the ability to, protect our clients from the downturns, because that is unique to what we do. It's unique in having this rules-based approach. There's no emotion to it, and we make sure that our clients don't lose all their money. All right. The main drivers this quarter, January feels like such a long time ago at this point because of all the events. But in January and early February, there was the SaaS disruption. This is the software as a service. U.S. software stocks fell 23% as a collective index, led by Microsoft and really, Salesforce, but affected a lot of the tech companies generally, but software particularly. And it was this storyline, this story thread, which we talked about in some webinars this year, that, AI is so good and it's so powerful that essentially enterprises are going to build their own software. It's going to be proprietary to them. They're going to use, Copilot and some other AI systems to code it, and they're not going to need their Salesforce. They're not going to need their Workday. They're not going to need their Datadog. They're not going to need any of these platforms that essentially, use data to, create business information for businesses to act on. That AI is so powerful that every enterprise is going to be able to code their own programs and not going to need to pay Salesforce or any of these other platforms, Atlassian or whatever it is. And now there's some truth to that. I mean, AI is powerful. The coding is one of the most powerful parts of AI. I've never coded a day in my life, but if I used a AI bot to code, I'm sure I could build an app if I really wanted to. So there is some truth to that. But there's also some truth that, nobody's trying to rebuild Microsoft Word. It's just not necessary, right? I'd rather pay Microsoft for that. And, same thing with Salesforce. Am I really going to build an entire CRM proprietary for my enterprise? Possibly, but definitely not next year. Maybe over the next 10 years, 5-10 years, we could do that. Let's assuming I was like a big Fortune 500 company, but it's still unlikely. And so it was really just a way for the market to find something to grab onto to sell some winners and to see some rotation in the market. So I think it was overall healthy. I think that storyline has played out. Yes, there's some truth to it, but as many things that happened in the stock market, it was likely an overreaction. But by the time we got to late February, we had the Iran conflict, and this is the thing, right? There is nothing else that really matters when it comes to the market headlines besides the Iran conflict. So we're going to talk a bunch about that. It is a touchy subject because it's fairly divisive politically, but we're going to talk about it today. So following that conflict, oil spiked 55% in March. That put a lot of pressure on risk assets. Essentially when oil goes up, price of gas goes up, diesel goes up. That's an input for all goods costs. So the expectation for inflation rises. As the expectation for inflation rises, the expectation for Fed rate cuts start to go down, assuming that, hey, if we have a bunch of inflation, well, the Fed's not going to be able to cut. That starts to filter into the credit market, the rates market. And what ends up happening is rates start to rise. And that puts pressure on risk assets. Risk asset pricing is a multiple of interest rates. So as interest rates go up, risk asset prices get discounted back further. And so, that was pressure on risk assets. Hopefully it's a temporary oil spike. If the Strait of Hormuz can get reopened and the oil can, get back onto the global market in a way close to where it was prior to the conflict, then, we should see some of those pressures abate, which should help, the interest rate market and should take some of the pressure off the risk assets. But again, the 10-year treasury only up 4.1 to 4.3. I mean, we're not talking about massive moves in the rates market. So I don't think that that's the real pressure on risk assets. I just think the geopolitical uncertainty is the main problem. But again, Fed rate cut expectations did go from 3 to 0. The expectation was that we were going to get 3 rate cuts, 25 basis points apiece, through the end of 2026. Now the expectation is 0. Based on the SOFR curve, it's actually expecting some hikes, which is not really likely. The Fed has not said that at all. But yeah, again, expectations have definitely come down. And the 2-year treasury, I talked about the 10-year moving up 20 basis. The 2-year treasury moved up 40 basis points because the 2-year treasury is more reflective of the overnight lending rate. So if expectations for Fed rates change, that affect the 2-year rate more than the 10-year. Now on the positive side, we've got fiscal stimulus from tax refunds. So we got the new, Trump code, which was a change in the tax code from what was planned. So there's actually going to be more refunds than people are used to. And so if bigger refunds come in, then that money's going to get spent in the next 3 months. So that's a positive actually in the short term. So you could look at, a rise in interest rates really being affecting demand in the long term. It'll affect demand over a 6 month to 1 year basis. But tax returns, higher than expected tax returns, or tax refunds will create demand and positive demand in the next 2 to 3 months. So it's actually positive in the short term and hopefully keep the economy on track a little bit. Really, obviously, the resolution hopes are the big thing. We've got even more hopes that this can be resolved, that potentially we're in this 2-week ceasefire, although that's tenuous at this point also. But, there's a lot of hope. And that's really what the market moves on. If there's hope of resolution, the market goes up. If there's fear that there's going to be escalation, the market goes down. We've got weak labor market. There's been significant weak labor data this quarter, so we'll review that. But most important from a investment standpoint is this AI story is just getting better. And we're going to talk about that too. So, all right, overall on asset performance, commodities definitely the best. Commodities up 35.9%, gold second best up 8.1. Commodities include all the energy commodities, gas, so oil, etc., but also includes, you know, industrial metals and other things like that. But the real contribution to that growth in commodity pricing has been oil, right? That's clearly the contribution. So you kind of just, unless you're trading, commodity futures or something like that, it doesn't really matter to you. What matters is you look at the second to worst and the third to worst. That's the Nasdaq and the S&P 500. Again, forget about Bitcoin. It's just a risk off play, and Bitcoin's got its own storylines. But Nasdaq being the second worst and S&P. So U.S. and especially tech U.S. equities down this quarter. That's not great. So we'd like to see that reverse, and we do think it will. So it was just a tough quarter. Again, Iran war really shaking the market. Again, looking at the individual stocks now and look at the individual sectors, where are the leaders? Well, the leaders are energy, obviously, but then materials, utilities, and staples. These are the most defensive parts of the market. And you can see the traditional leadership, the leadership that's occurred the last 3 to 4 years, tech, communication services, discretionary, financials, these are all down. So this is not what you like to see. You don't really like to see defensive leadership. It doesn't purport good things for the future. However, we think that, again, this is temporary. This is the Iran war, the uncertainty, and obviously the energy prices affecting sector leadership. But I do think that'll be short-lived, and we'll see a return to, again, I'll call it traditional leadership, but leadership that we've seen in the last, 3 to 5 years. So on the Iran issue, the concern obviously is higher inflation, but it's also demand destruction, and they go part and parcel, but this is kind of how it works. This is the Singapore gas oil spot price, and so this is essentially diesel pricing in Asia. And you can see the pricing latest up $193 a barrel. The spike is incredible. More than 100% increase. Just a real problem. It's a problem for the entire supply chain if diesel pricing looks like this in Asia. And same thing with jet fuel, Europe and Asia. And we're talking about Europe and Asia because Europe and Asia are definitely more impacted by the Strait of Hormuz than we are here in the Americas. But I mean, look at these numbers. It's just an incredible jump in the price of energy. And pardon me, that is what is to be expected. In fact, you usually see the the other side, the distillates, right? The actual the actual used product, the diesel, the jet fuel, that's actually going to rise at a faster pace than the input, the oil, because that is actually designed in the marketplace to create the demand destruction to make sure that they don't run out of supply. So the pricing on what people are using actually jumps higher than the oil because that's the market's way, the free market's way of creating the demand destruction so as to make sure that we don't run out of supply. So given all that, that does create concern for, again, demand destruction. So that would be, recessionary. So that is something to be aware of and something we're watching. Again, on the inflation, you could see the crude price, that purple line jumping, obviously almost up 50%. And you can see the green line starting to fall, which is the contribution of energy to the CPI calculation. So as the energy price rise and the change in year-over-year pricing goes up, well, then it actually starts to contribute more to the CPI. So, we're starting to see that increase in the energy CPI pricing, which is not good for inflation and, not good for Fed rate cut expectations. All right, so we talked a lot about the Iran war and how it's shaking kind of the energy pricing and the expectations for inflation. At the same time, we've got this weakness in jobs. Um, the yellow box on the bottom that's highlighted, those are the revisions, and so that's its own storyline essentially, that we release these numbers, and then by the third revision, they're always way less, and the revisions are getting worse. Which means like the reporting is getting worse. The the calculations of non-farm payroll is getting worse, but that's always been terrible. What I think is more concerning, and this doesn't even really go back all that, because this only goes to November. I'm not sure why this chart doesn't go any further, but November, so you're talking October as well as August as well as June, were all negative growth months where non-farm payrolls was negative, where we were losing jobs on a net basis. But if you go fast forward it, we've had some negative months just now. So look at that cluster of negative non-farm payroll months that has got the Fed's attention. This chart goes back to 1996, and it shows every recession in those red lines, 2001, 2008, and COVID. Well, what's familiar, again, forget about COVID because it's kind of an odd one, but when you look at 2001, 2008, what's common is you see a bunch of purple dots. You see a bunch of months where we're shedding jobs on a net basis. We're negative. Well, now look where we are. We're shedding jobs. Okay, so statistically, we're probably headed to a recession. But I actually don't think that that's the case. What I think is happening is we're seeing a recalibration of the labor market given this change in technology and AI that we've never seen before. And so I'm giving it the benefit of the doubt. Okay, but let's be clear that if we see these type of negative non-farm payroll numbers and we're seeing this cluster, we should be going into a recession. And if we're not, that's the anomaly. Now, again, I believe we're in the anomaly, and I believe that's because we've seen 5 years, 6 years of some very unique circumstances. You had COVID, then you printed $9 trillion, you saw inflation at 9%, then you jacked interest rates from basically 0 to 5 within a 12-month period. And then you release AI, which is basically shedding jobs in a bunch of sectors of the economy, but housing's still strong. So you have like this very crazy arc of events over the last 6 years that I'll give, again, the economy the benefit of the doubt that this non-farm payroll negative print over and over and over right now is just a recalibration, right? Because of how high those green dots are going back to 2020. So we're hoping that that's the case. But again, to be clear, statistically, it's not. Statistically, this shows that we're in a recession based on this chart. But that is not that's not the case. So that's not our base case, rather. So we're hopeful of that. But again, we look at lots of charts. We look at different survey data. We look at hiring rates, firing rates. We look at the the layoff numbers from Challenger Gray. We're looking at all different types of data. They're all showing weakness. Again, so we're hoping it's just a recalibration. We're hoping it's just AI creating productivity, but recalibrating the labor market. But this is concerning. Look at the firing rate, the green line on the bottom. It's starting to move up, and the hiring rate is falling. This is not good for job seekers. I would not want to be a job seeker right now. It does not look very positive. And again, another chart that shows we've got a real problem. Look at all those red lines, the red lines of the recession, 2008, 2001, and this one actually has the 1991 recession. What happens is when you're in recessions, healthcare accounts for more than 100% of all new job creation on a net basis. Because essentially you're losing jobs, but healthcare is always adding jobs because it's basically a quasi-government sector. So you would have basically a net growth in healthcare of more than 100% of all the new net jobs. And we're seeing it again, right? We're seeing where healthcare is accounting for more than 100% of all the jobs being created across our country. I mean, that is a terrible statistic. Again, I'm hoping it's an anomaly, but it does show that there is weakness in the private sector, and that is something we need to be aware of. Again, now here is this one part that is odd, where you're seeing kind of a bunch of weak data, but then when you look at the residential construction payroll, it's only down 1.08% on a 3-year basis. It's not down all that much. So looking back at all the recessions at the red lines, when you have recessions, you see reductions in the residential construction payroll numbers, usually 8 to 10%. We're not seeing that right now. We're not seeing that, I think, again, because of this odd paradigm, this odd timeline of events that happened in housing. You had interest rates went to zero. We had the COVID pandemic. People were working from home. They moved out of the cities into the suburbs. So the houses got gobbled up at 0% interest rates. People then also refinanced. Everybody refinanced at, zero interest, so mortgage rates at 3 or 3.5, 4. And so everybody's got these low mortgages with high debt. And then so now, fast forward, mortgage rates are now 6.7. Nobody can sell their house because they don't want to get rid of their 3% mortgage and pick up a 6% mortgage. So they just stay still. So then there's no housing resale. So as if you're a new buyer entering the market, which there's a ton of them between millennials and Gen Z, huge generations of people that are trying to buy homes for the first time, there is no option. There is no inventory. So what are they doing? They're either buying a house that's smaller and they're renovating it, or they're just building a house. So residential construction payrolls have held up, right? They're still working. We're still building houses because there is no inventory to buy, no matter how much money you have. So this is kind of the interesting paradigm that I think is holding up some of the trades and staving off the recession, to be honest. Go through this just quickly. Essentially, it's back onto the inflation dynamic a little bit, but also I think it relates to what we just talked about with the weak jobs data. So you can see here, if you look at that bottom chart, you see that blue line. The blue line is the expectation of the Fed for what interest rates will be at the end of 2026. And that gets adjusted every couple months in the SEP. The most recent SEP, they held it constant and maintained that the estimated interest rate for the end of 2026 is 3.4. Yet the purple, which is the implied rate, that's what the market's telling us, that actually jumped based on this Iran issue. So what the market is saying, well, hey, interest rates are actually going to go up. The Fed has not said that yet. The Fed is maintaining that they're not going to raise rates. So even though the market is saying, hey, we got issues with inflation, we think that the rates will pop, the Fed is holding out hope that they're not going to have to cut. I think the reason they're holding out that hope is because they see all that same weak jobs data that I see. And when they look at their dual mandate, yes, they're concerned about the inflation that's going to result from this Iran controversy and this Iran conflict and then the subsequent increase in oil prices, but they're also very concerned about the data on jobs. And so what they're trying to do is hold out hope that the Iran conflict gets resolved so they don't have to raise rates. And they don't want to put that out in the market. So I think it's just an interesting paradigm. But again, looking at the dual mandate, there's risks on both sides. There's risks of weakening labor market and there's risks in rising inflation. And the Fed's trying to deal with both of them. All right. So talked a lot about Iran, how it's affecting energy prices, Fed rate cut expectations, and the labor market. Again, all those are fairly concerning, right? None of that is all that great. So I want to move to what's really good, which is the breakthroughs that we've seen this quarter in AI. And it's not really in the market necessarily, because the market has not done all that well. But in the actual functional artificial intelligence and the releases of OpenClaw and some other programs, OpenClaw being the biggest open source program that allows people to build agentic AI digital workers, the breakthroughs have been incredible. And I am seeing this firsthand. Some of my colleagues, I'm a co-owner of an insurance agency that my brother actually runs. My brother has been implementing these agentic AI digital workers to do a lot of his back end work. And it's incredible, what he's got going on. I mean, these, again, agentic AI is, I'll kind of read this little point because I think this lays it out. So we're transitioning here in 2026 from co-pilots, where you're basically go into a large language model or you're using like a co-pilot, but you prompt the system to do something, to now an autonomous agent. So where you kind of teach them some things to do, but then they'll be proactive, right? They're going to independently scrape emails, CRMs, look for system updates, and then they're going to use those updates, use those emails to um, execute multi-step tasks. As an example, on the insurance side, my brother can feed data from a website about a new prospective client and to the agentic bot, and that bot will actually be able to go into the different companies and quote a homeowner's policy or something like that at 15 different carriers, and then send back to my brother and his team a report of which company is the best price for that client. So what ended up happening is, my brother does not have to hire any back end support now, right? He doesn't need somebody to sit around and input all that data into all those different companies and quote out that homeowner's policy. Uh, it will save him 75 to 80% of his back end support staff over the next 12 months. And that is new here in 2026. That is a new system. And that is the promise that AI has had, and it's working now. Furthermore, you can actually have multiple agents now, and you could have one agent controlling 10 other agents operating tasks within the business. And this, again, is the future of AI and what the promise is on the enterprise level. And it's being shown out in the GPU usage, which I'll show you. Essentially, this is being adopted at such a fast pace now that the hyperscalers and the data centers can't even keep up with the demand. So this is a chart I was actually talking about. Look at that B200 line. That's the red line. So these are the different GPUs from NVIDIA, right, over time. The A100 was the first, I think, and then the H100, then the GH200, then the B200. But this is the percent of minutes in an hour with on-demand availability. So let's say you're operating on the Amazon Web Service cloud system, right? That's where you have your business applications and you're running your business, right? Let's say you're running your CRM, you're running your website, whatever it is. And you're building out some AI tools for your employees to use on your internal system. When they go to use it, they're pinging against the data center. And the data center has these GPUs in the data center, right? They've got the best B200 data center GPU. So when you push a task and you're trying to, do something, or you're trying to train your model or your agentic bot, and you're trying to work through a workload, you're going to be basically renting the GPU from Amazon Web Service. And what's happening is, look at the percent, they have no availability. If you push a task over to your Amazon Web Service cloud, there is nothing available on the B200. So what ends up happening is you get pushed to maybe the GH200, or your workload's going to get completed. But the point is, look at all those lines in the last quarter just plummeting to zero. That's because everybody is using all that on-demand availability, and they're using it because they're finally seeing, for the first time since 2022, the enterprise use case. And it's agentic AI bots working for each other, working for you, and doing all the tasks of an entry-level employee, a second level, third level, fourth level. They're going to take out massive swaths of the labor market very quickly. And so, again, looking at the labor market and all that is important to understand the risks that we have, but it's happening, and it's happening very quickly. And again, I have the benefit of seeing it firsthand, and it's been amazing to watch. So again, another chart just showing the same thing. You've got the data center spending ramping, office construction spending dropping. So what does this mean? Well, it means more GPUs, more CapEx, more money and investment going into building data centers, which is where we are invested, and less money building offices, which means less money hiring office workers. This is the shift in the economy that's happening. It is undeniable, and it's being propelled by uh this agentic AI um adoption, and it's going to just ramp higher, and the office construction spending is going to ramp lower. Same thing here. Again, you're looking at the purple line. This is the most AI exposed industries shedding jobs, right? On a net basis, negative. And that purple line is just going to ramp faster and faster, lower and lower. So definitely some cooling in the labor market ahead. The hope is that it's going to be isolated enough, and there's going to be enough recalibration and people retraining so that we don't see this major societal issue. But undeniably, it's happening, and it's great for earnings, right? Because margins will go up as productivity goes up. And that's, as investors, that's what you're looking for from a earnings standpoint. Just to touch actually back on the CPI side, but more related to the data center side, look at this ramp in CPI, the electricity component of CPI, right? Up from 200 to 300 over the last 5 years. And the usage is following right along with it, or whatever, the other way around, doesn't matter. But the point is, we're using so much electricity to run these data centers that it's putting pressure on the grid. So we got to resolve this. We got to resolve the Iran issue, because those will both, if we don't resolve them, will result in higher inflation. And that'll undo the inflation expectations that are in the market, and that's not great for anybody. All right, so now to the 200-day moving average, what we're doing tactically within the portfolio. So as many of you recall, on the 19th of March, we reduced equity exposure based on us crossing the 200-day moving average. That's when we crossed this purple line right around there on the right-hand side, okay? This chart is an interesting chart. This goes back to last year because I want to draw some parallels. And I'm going to try to put all this together. I tried this yesterday on the webinar, and I fumbled it a little bit, so hopefully I get it a little better. But there are a lot of parallels between Tariff Liberation Day and today, Iran conflict. There are parallels from a tactical standpoint, from a S&P 500 price action standpoint. There are parallels from the story arc, the personality, Donald Trump. There are a lot of parallels. From a tactical perspective, right? Just a price action perspective on the S&P 500, right? U.S. large cap index. On both situations, we crossed the 200-day moving average. So in both situations, we were able to de-risk, protect capital. What happened back then, and actually just this chart doesn't show it because this was published at the end of the quarter, and we've now moved above the 200 as of yesterday. But what happened on both fronts is it comes down 10.5%. In the tariff case, it went down 20%. Here, we only had the 10% drawdown. But then it basically retraces on better news, and it gets back above a 200. And once it can get to a 50% retracement, which is halfway up that initial 10% crash, once it can get back to that 50% retracement, in this case 6,600, it can find support to go to the next level. Okay? And so that's what we're looking for. Now, again, this doesn't trade, this 50% retracement rule, if you will, doesn't affect our trading rule. Our trading rule is very simple. It's 200-day moving average out, 200-day moving average in. There's nothing to do with the 50% retracement. But it turns out the 50% retracement is usually in line with the 200-day moving average. You can see the 50% line cut in the 10% reduction is basically right on that purple line. So if we can get above the purple and above the 50% retracement, that is support to take the leg to the next level, assuming that the good news supports that. Now, to draw the parallel, right, to go back to last year, a year ago, just over a year ago, April 2nd, 2025, we saw the billboard tariff release, right? Liberation Day. Hey, we're going to tax everybody 150%, blah, 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 blah. And the market hated it, right? It went 5%, 5%. I mean, it dropped 10% in a day. 2 days. 5% first day, 5% second day. That's that big drop down here. That was terrible. But then 7 days later, Trump rolled it basically all back and down to 20% across the board. Fast forward a year, they've now essentially rolled it all back, right? They just ruled it unconstitutional in the Supreme Court. So going back then, you had this big release. We're going to tax everybody 100%, blah, blah, blah. And then over time, it all kind of comes rolling back. And the market senses it. And the market technically can get above the 200, get above the 50% retracement, and it can find stability to move forward. Because it knows, well, the tariffs, all that crazy talk was not really real. And again, fast forward to February, whatever it was, when they ruled on the Supreme Court, it was truly not real because it's now pretty much all been struck down. To today, okay, you got the Iran conflict. Market hates it, right? Market doesn't like it. You have that last drop. I don't even know if it's on this chart, but we had this last drop on the bottom was we're going to bomb all the civilian infrastructure and we're going to destroy an entire civilization, right? Those were the tweets that we were getting. Next day, roll it all back. We found agreement. We got a 2-week ceasefire. Market could pop. Market could pop. It could get above the 200, get above the 500, 50% retracement. And then it can find stability to move forward, assuming good news continues. So again, the story arcs are the same. And I'm hopeful that the story arc is the same. Just like I was hopeful that the tariffs weren't real, because that would have just created total havoc. That's why the market was having a fit. I'm hoping that we don't bomb a whole civilization off the face of the earth. Right? So, I don't think anybody wants all those civilians murdered. Not to say anything about this Iran war, because I really don't even necessarily have a real opinion on it. I know they are, obviously, Iran is the face of terror across the world for many years. So they're a terrible, evil regime. So I'm not talking much about that. I'm just saying I don't know that anybody wants to see us drop a bunch of nukes on them. So all that to say, hopefully we could find that 200. We could find that 50% retracement. We could find some stability in the region, some peace, and we can move forward. Now, the chart, that's just showing where we are. We did cross above the 200 on the right hand. So we're now above that. We bought in just on that purchase over the 200 we bought in yesterday. So hopefully, again, we can find the support to take the next step up. The question is, when you get back in the market, okay, we're getting in on the 200. That's non-negotiable. That's, just a tactical move. The question is, how do you invest going forward? It all depends on whether or not you think there's a recession. If you think there's a recession, you want to be defensive no matter how you invest because you're not going anywhere. But if you don't have a recession and you had a 5% pullback, which we had, it actually results in a really good next 12 months on average. And that's the base case for us, that we're on that green line because we don't think there's a recession. All right. But the bottom line, the Iran war disrupted the cycle. We had an investment super cycle going, and we still do. AI is the best investment theme. It is the best thing that's ever happened to us as investors in our lifetimes. That is my belief. And the Iran war has definitely thrown a monkey wrench in it because it just takes over the headlines. The oil spike likely to keep the Fed in a holding pattern on rate cuts until more labor weakness emerges, which it will, based on AI. But outside of the war, again, AI remains the dominant secular theme. That is where you want to have your money. That's where we have our money now that we're back invested above the 200-day moving average. But at the end of the day, the S&P is now beholden to Iran. Doesn't matter what the markets, want to do as far as earnings or anything like that. It is 100% Iran. If there's escalation, the market will go down. If there's peace, the market will go up. And that's it. Okay? So we got to be aware of that. I need to go through that. So I threw this slide in yesterday, right before the webinar, because I was just reading, the 10-point plan that Iran put out as part of what Trump said was um the basis of the negotiation. And now there is there's a question about what was released by the Iranian regime, whether or not that's real. But if it is, it does throw a concern out there, because what they were saying is, okay, the 10-point plan, we want the U.S. to accept our nuclear enrichment rights. Okay, so it's not going to decrease any of their enrichment levels, and it's not going to get the stockpiles out of the country. They're not going to do anything to reduce their missile and drone capabilities. They want strategic control of the Strait of Hormuz. They want our total withdrawal of combat forces out of the Middle East, and they want reparations. They want money. So all these, which were part of their 10-point plan that got released, if that is truly the basis of negotiation, then it's a bit of concern, because these have nothing to do with what our military objectives are. So that does throw a concern around our hope of this 2-week ceasefire turning into, real peace. Again, the Trump administration says that the real 10-point plan that they're working off of has nothing to do with the one that was released by the Iranian regime. He was saying that was fake news, and there's kind of two regimes working and things like that. So again, there's still hope, but I did want to throw this out there that, okay, yeah, we're basing investment on hope of peace, hope of resolution. But if this is the basis of the starting point of the negotiation, we've got some concern that we're nowhere near that, because these are nowhere near where I think we are as a country. At least that's what they're telling us. All right. Anyway, again, not to focus too much on this, because we don't know if this is real, but it is a question. And again, I don't like to be too hard on Trump. I don't like to be, too political at all, really even have a stance on it, because I kind of don't. My stance is on the numbers. And if the markets are going to get affected by something, I've got to look at it. And on the ground, looking at this is a tenuous ceasefire at best. And we want to be aware of that, because now we're invested, and we're making investment decisions, unfortunately, based on this, which is crazy. This is the hardest part about this, because the idea that the market trades on what Donald Trump says is insane, because what Donald Trump says is insane half the time. It's like all over the place. It's like, very difficult to follow, or to have any cohesive there's not much cohesion to what he says. So it's very hard for all investors, and we're all dealing with this together. All right, so just to wrap up, I don't want to, normally we do like three company highlights at the end of these. I'm only doing one, because there was so much that went into this webinar. I could have added another 15 slides. I mean, this has been one of the most news-heavy quarters that I can remember. A lot of changes. So Amazon, I did want to highlight it. It is our top pick. It's our favorite company. I own it personally in a big way. I own it within the managed portfolios. Amazon is a huge holding of ours, and for really good reason. Okay. AWS, Amazon Web Services, which used to be a 2-3% of the business, it was a side project for Amazon, has now grown to be a huge growth engine. Sales reached $35.6 billion. That's a 24% increase year over year. AWS accounted for 17% of all of its net sales, generated $12.5 billion in operating income, up another 20% from the fourth quarter of 2024. This is, again, the end of year numbers. And it's primarily driven by its relationship with Anthropic and what it's doing with its custom silicone. So Amazon creates Trainium and Graviton. These are custom chips. They're ASICs. They're basically designed for specific purposes. They're much more efficient than the NVIDIA chips. They've got their own project Rainwater, I think it was. Forget the name of it. But anyway, they've got, I think, like 50,000 Trainium chips. Is one of the biggest data centers out there. And they're growing that business by triple digits, 100% plus. Anthropic, which has Anthropic Claude, which is the large language model that backs, in many cases, a big part of agentic AI. So there's new agentic AI that we talked about, like the one that my brother's using. That's powered by Anthropic Claude. Now he's also integrated with OpenAI and Gemini and some of the other systems. They're integrated with all of them, but the backbone, the overwhelming majority of use case is coming out of Anthropic, and that's across the board. Anthropic is looked at this point, Claude, as one of the most powerful systems to run, this agentic AI revolution. So yeah, there it is, the 500,000 Trainium 2 chips, and that's powering the AI model Claude by Anthropic. AWS then offers this Anthropic's models to all their cloud customers. Okay, so they're renting GPU space, they're selling their chips, they are just crushing it, and they've partnered with one of the best in the business, which is Anthropic. They now own estimated 19% of the business. Anthropic will likely go public one day in the future. They just did a new valuation, went way up. So I think Amazon had invested like $8 billion, and that's like, I don't even know what that's worth now, maybe $100 billion or something like that. Just an incredible investment. And it's not just an investment, right? It's a strategic partnership with one of the best in the business. So we just really like where AWS is going. Obviously, we like the consumer business also. So I think it just creates this really stabilizing force, having consumer business, having the AWS business together. Just an incredible business. You can see the sales growth there. 24% estimated growth for this year, 22% for next year, consistent 20+% growth in AWS. That is what's driving Amazon. And from a chart perspective, it's a buy, right? You were up here at almost $250 a share. You got crushed, and we're now finding consolidation. We're now moving higher. The chart looks great technically. The fundamentals look great. It's just phenomenal. Let me pull myself over here. So that's what we've got here for today. Again, I appreciate you taking the time to watch this. It is super important for us to continue to articulate our thought and our process. And I was thinking about this the other day, and I wanted to just kind of walk you through something. So again, our strategy is we invest on the fundamentals. We invest in companies that we believe in. We believe in their management. We believe in their business model. We believe in their, their past. They got to have good past production, and we think that the future is even better, right? We look for double-digit earnings growth. Doesn't matter the industry. And we're investing in heavily in this AI infrastructure build out, and eventually the AI integration into our entire economy. We are going to retool the entire global economy with artificial intelligence and robotics. 100% that's going to happen. And if you invest in that theme, it will be the best thing you ever did. So we want to make sure we're doing that. However, things happen. 2008, we had a credit crisis. And I'm not saying we'll have one again, but I want to imagine, or even 2001. 2001 is even better to look at. In 2001, you saw this massive bubble in tech. None of my customers, my clients, I think, were retired in 1999. So everybody that's watching this was either working, or, some of my younger clients, maybe they were still in school. But in 1999, 27 years ago, if you were retired then. So let's say you retired in 1999, you were in the market, and the market crashed in 2001, went down 50%. You would have been saying, I should have seen it coming. I should have seen it coming, right? Because, well, your portfolio was up 200% in a year, and you were highly invested in tech, and then, the market just cratered on you, and the earnings were never there. The revenue growth maybe, but the earnings were terrible. And the multiples were totally out of control. So when you look back on it in 2004 and you're looking back and you say, wow, I should have seen it coming. That is the worst thing to ever have to say. And should you have seen it coming? Like, again, if you were in 1999, maybe. But 2008, that was even more hidden because the banks, the rating agencies, they were hiding all those credit problems. So unless you were really dialed into the subprime mortgage market, you probably didn't even see that coming. But so they're hard to see coming. But in hindsight, it's very obvious. And you're always saying, well, I should have seen it coming. And I ruined my whole retirement because of it. And that is why we do what we do every day. We come to work every day to make sure that everybody we could possibly help, they will never have to say those words. Because the way we invest fundamentally, and then we integrate and overlay these technical trading strategies, my clients will not lose massive swaths of money, right? It's not possible because of the 200-day moving average. So given that, my clients will never have to say, I should have seen it coming. They will never be in a position where their retirement is significantly altered versus where it was a year or two prior to the event. And that is why we come to work every day. And that is why we do things like sell on the 200-day moving average in March. Because when this Iran conflict started to really escalate, we didn't know where it was going. We still don't know where it's going. So we're going to still tactically sell if we go back below that 200-day moving average. Because we are more interested at this juncture, this point in time, in protecting capital than anything else. It's the most important thing. So anyway, I just wanted to reiterate that because I have some, I've had, I feel so good about what we do. And every time this happens, tariffs, and now, right? So this is the second trade in 18 months. Usually it's every couple years, but we're in a follow the market, and we made these trades and we executed on our strategy and we reduced risk and we protected capital. And every time we do that, I feel so good about what we do. And I know it's the right thing to do. And we just wanted to reiterate that to make sure clients know why we do these things. And again, thank you for joining this, for joining this call, spending some time, and hopefully you enjoyed it. Make sure you're scheduling. If you haven't scheduled already, your one-on-one. We look forward to seeing you. Thanks.